Tech Talks. Today is October 15th, 2023. I'd like to thank you guys for joining another episode. Today, what we're going to talk about is the FDIC. I know many of you have probably heard of it, seen it on commercials or especially bank commercials and stuff like that. But we're going to get in today about what is the FDIC. That's an acronym for Federal Deposit Insurance Corporation, which was created in 1933, enacted during the Great Depression to restore the American banking system. Um, More than one third of banks failed in the years before the FDIC was created. So banks um, wanted to create something to protect the consumer. Um, the insurance was limited at that time to only $2,500 per ownership category, but has since increased to a significant. It's increased several times now since the enactment of the Dodd-Frank Wall Street Reform Consumer Protection Act in 2010. The FDIC insures deposits in member banks up to 250,000 per ownership category. Uh, Now, there is a specific breakdown for that I'll get into later, where you will find that not everything is insured by the bank users or members of banks. They don't really know the intricacies of how banks work and um, how banks make money. One of the ways that banks make money is from your deposits. They take the money that we put in the bank and they loan that money to other members at a certain interest rate, and then from those interest rates, they actually make money. Now, there are other ways that banks make money, but I brought that point up just to let you guys know, um, basically, that this is one of their main sources of income for banks. Now, what banks do is that when you put your money in the bank, they have to pay a premium to the FDIC as is like their insurance policy amount. And so every bank in the United States pays into the FDIC. One of the things that I wanted to talk about was what is covered. You may think, well, I have my money in the bank. I have under $250,000 in total assets, so everything should be covered. Well, not necessarily. So they have some general principles of what is covered, and I'm going to give you a quick breakdown. So, what's insured, and it's our checking accounts, money market accounts, savings accounts, now money market mutual funds, and stocks, bonds, or other security mutual funds, annuities, insurance products, safe deposit box, actual material that's locked in a secure place in the bank. And I don't understand why that's not covered, but it's not. So they have a process in which they go through when there is an issue with a bank, where a bank may be going through some either management or financial issues, and the FDIC may have to step in. Now, the FDIC, what they do is that if a bank is failing, they physically go to that bank and they shut that bank down. They lock the doors, and they give the employees a long speech about now, we've taken over this bank, and they let them know that we're the actual, you actually work for us now. The employees actually work for the FDIC once it's taken over. Uh, One example that I found was a bank called Heritage Bank. Um, it was in the 2000s where they ran into some financial issues, and the FDIC deemed that the bank was failing, so they actually took it over. And it explained the process, and what they do is they physically go in there, they lock the doors, they talk to the employees, they go through the records, they try to find a another bank perhaps that could take over that bank, so that it could, the day-to-day operations could continue. And then they turn around and say, hey, this bank is not going to survive, so what we have to do is we have to start selling off the assets. Now, in the process of all of these things happening, the FDIC's one of their main responsibilities is to make the depositors whole. So they go through, and as I explained earlier, the accounts that are insured, they actually go through the customer accounts, and then they if you want to get your money out of the bank, I believe they didn't give a specific amount of days in which the bank will make you whole, but they do have a process. And in the last situation, I believe they said it was in 48 hours they were able to uh, make the depositors whole on those accounts. The FDIC is ran by the government, but it's not supported by public funds. It's basically supported by the premiums that banks pay into the FDIC. Also, they make money through special fees and unsold failed bank assets. One of the things that the FDIC has is they have $100 billion line of credit with the federal government. So um, historically, the FDIC has never they've always been able to fulfill their obligations when it came to a bank close failing and depositors getting the money that they were eligible for based on the category that FDIC insures members of a particular bank. So when the FDIC decides that a bank is under suspicion of failing, what they do is they have a what they call membership criteria, and five of those criteria is if the bank is well capitalized, 10% or higher, adequately capitalized, 8% or higher, undercapitalized, less than 8%, significantly undercapitalized, less than 6%, critically undercapitalized, less than 2%. And when a bank becomes undercapitalized, the institution primary regulators issues a warning to the bank. And when the bank drops below 6%, the primary regulator can change management and force the bank to take the corrective action. When that bank becomes critically undercapitalized, the chartering authority closes that institution and appoints the FDIC as receivers of the bank. So that is something that you would think that a bank would be a institution that will never close, but mismanagement and bad business practices would definitely put a bank in a situation where uh, they could lose 23. In a future episode, I may do a breakdown of the actual the five people on the FDIC board. If there's any interest in that, it could give you an idea of why they make the decisions that they make, and how they run this entity. So I was asking myself, why is it that the banks, when the FDIC decides that a bank is becoming insolvent, why do they seize the bank at nighttime? And what I found out is it says because the FDIC makes depositors of said bank whole. I'm sorry, I was in the wrong place. Um, what it is that they don't want the consumer or the members of the bank to make a run on the bank. So that's the reason why they do it at night. So when the bank closes, uh, after a certain hour, you can only take so much money out of the ATM machine. And so what they do is that to prevent runs on banks, they do it at night, which is it makes sense. Even though I think it probably causes more hysteria for the next day, but it definitely makes sense why they do that. So the FDIC, they have a designator, what they call banks. They call them IDI, and the IDI is up. They say depositors are assured at each IDI for up to at least a standard maximum insurance amount of 250,000, which is an acronym's standard maximum deposit insurance amount. The SMDA, the SMDIA is a $250,000 made permanent in 2010 under the Dodd-Frank Street Reform and Consumer Protection Act. The insurance amount is the principal and accrued interest. So you learn through getting this information that they will insure your interest, accrued interest as well. So the board of directors. Earlier, I was telling you that there are 5 members. The board of directors have 3 appointed by the president of the United States with the consent of the United States Senate, and 2 ex facto members. The 3 appointed members each serve 6-year terms. No more than 3 members of the board may be of the same political affiliation. Interesting. The president, with the consent of the Senate, also designates one of the appointed members as chairman of the board to serve for 5-year term, and one of the appointed members as vice chairman of the board. 2 of the ex officio members are the comptroller of the currency and the director of Consumer Financial Protection Bureau. Martin J. Gurenberg, the chairman of the board; Travis Hill, vice chairman; Jonathan McKernan, board member; Michael Su, acting comptroller of currency; and Rohit Chopra, director, Consumer Financial Protection Bureau. So, in short, the FDIC is an insurance company for banks, which in turn is an insurance company for us up to $250,000 for our bank accounts, which I think is a really good thing to want to protect the consumer's money, because we don't control the day-to-day actions of banks. So it's good to know that even back in the 30s they decided to look out for the depositors. Um, so that was just a brief overview of what the FDIC, Federal Deposit Insurance Corporation, does. That it is a government agency, but it's not financed by the government. It's financed by banks by paying premiums. Um, so thanks again for listening to uh, episode 13 of Financial Tech Talks. Um, our goal is to inform our listeners on giving you a basic understanding of things, and then you can build on that for yourselves. I recommend that everyone gets a financial advisor to assist them in their financial needs and their banking needs, and to read for yourself to get a better understanding of how your money, the money that you put in the bank, how that money is used and how that money is insured. So it's important to understand these things, especially the higher you get up the financial ladder. One last thing, I want to encourage you guys to follow us on our Facebook page, on our Instagram page, on our TikTok page. We also have audio podcasts on all major streaming services. So you can, for example, go to Spotify and just type in Financial Tech Talks, and you'll be able to check out some of our previous episodes. We appreciate all your support.